Welcome back to episode 3 of Tax Stuff You Should Know, a podcast sponsored by the law firm of Eric Fox Schiff. I'm Bob Pluth, and I'm here today with my esteemed colleague, Gene Magidenko. Gene, how are you doing today?
Well, I'm doing very well, Bob. Very well. At the risk of dating this episode, it's right before the July 4th holiday, at least that we're recording it. So there we go. Something to look forward to.
Terrific. Terrific. So we've got to get this out the door relatively soon, post July 4. What are we talking about today, Gene?
We're talking about one of our favorite topics, which is S corporations, Bob.
Terrific. I can't wait. Uh, S corps are can be very interesting animals, can be very tricky animals in that regard as well. So why don't we just dive right in?
Absolutely. So S corps, one might wonder why they're called S corps. It's because they're governed by subchapter S of the Internal Revenue Code. They were actually first introduced in the late 1950s by the Technical Amendments Act of 1958. They morphed over the years through various tax reforms by Congress. But today, they're effectively a hybrid combining pass-through treatment for certain purposes, mostly for profits and losses and distributions, along with corporate treatment for other purposes, such as liquidations and reorganizations. So really a fascinating topic and a bit of a holdover from an earlier time when options for pass-through treatment were limited. This was well before LLCs were introduced in the 90s and so forth. So there's some virtue in having S corps. Generally speaking, we don't see as many new ones formed today, but in certain cases, it may make sense, especially if you have a C corp that you're looking to convert into pass-through treatment. Conversion into an S corp is one of the few ways to do so without incurring gain in many cases. But there are some traps for the unwary there to watch out for as well. So what makes a company an S corp? It needs to fulfill certain eligibility requirements. First of all, it has to be a domestic corporation that's not ineligible to make the election. Ineligible corporations would be certain financial institutions, insurance companies, and DISCs, or domestic international sales corporations. It can't have more than 100 shareholders. Members of a family going back 6 generations, however, do count as a single shareholder. So if you have family ownership, even if there's a number of individuals who may be owners, for this purpose, the 100 shareholder count, it could be far fewer than that.
Gene, let me just interject that it's a really helpful provision. It includes not only family members, but spouses and former spouses. And I can think of at least a couple of family situations that we've been involved in where we're relying heavily on that, on that exception to the 100 shareholder rule. We end up having one shareholder, even though there are scores of people that are actual corporate shareholders.
Absolutely. It's a powerful tool in a lot of cases. And in most instances, S corporations are not widely held. So it's something that comes in handy quite a bit. In addition to the 100 shareholder restriction, you can't have as shareholders persons other than individuals, estates, or eligible trusts. Eligible trusts would be grantor trusts. It can be electing small business trusts or ESBTs, qualified subchapter S trusts, also known as QSSTs, and certain other varieties of trust. Additionally, tax-exempt organizations can also be S corporation shareholders, although there are some unfavorable UBTI considerations with a tax-exempt organization. So in a lot of cases, they don't like owning S corporation interests. However, it will not blow up an S election if you do have, let's say, a 501c3 as a shareholder.
Gene, let's tell our listeners what UBTI is, just to make sure we're all on the same.
Yeah, it's unrelated business taxable income. Essentially, it's a tax regime for nonprofits, which generally are not subject to tax. However, if they're engaged in an unrelated trade or business, vis-a-vis their core charitable mission, then they are subject to tax on income from that activity. And there's a provision under those rules that effectively says if a charity or other 501c3 or tax exempt owns an interest in an S corporation, that can trigger unrelated business taxable income in pretty much all cases, not just on a pass-through basis, but disposing of the interest as well.
Fair enough. Thanks.
Finally, an S corporation must not have a non-resident alien as a shareholder. This is a key. It can't have more than one class of stock. And this is something, and we'll discuss this a little bit later, that can cause a number of S corporations to run afoul of the rules. So if you're eligible, you fulfill these criteria, you can make an S election. And that's usually done by filing a Form 2553, with the IRS. The S election will be effective for the tax year for which it's made and all succeeding years until the S election terminates. So how can an S election terminate? There are several ways to have that occur. The first is it can be affirmatively revoked with the consent of the shareholders holding more than half of the corporation's shares of stock.
So, Gene, just to interrupt, my apologies. We're going to talk a little bit about shareholder agreements a little later as a way to sort of protect the S election. We've done situations where in the agreement we've raised the bar and say, and required, for example, 75% or 90% of the shareholders have to agree to the termination of the election, which is normally viewed as a important corporate asset. So we can raise that by contract if we want to.
Yeah, absolutely. It's that's just the minimum threshold. So anything higher can certainly be stipulated by contract and would be enforceable as a matter of contract law as between and among the shareholders.
Great.
So in addition to affirmatively revoking the election, if a corporation ceases to fulfill eligibility requirements in any way, it causes an immediate termination. So if you're revoking affirmatively, there are certain timing rules on when that can be effective. Whereas if you cease meeting eligibility requirements, that's an immediate termination. Finally, there are a couple of more specific scenarios where an S election could terminate. So for instance, if the corporation used to be a C corporation, it has accumulated earnings and profits from when it was a C corporation, and it has those for at least 3 years, and it has sufficient passive gross receipts, which typically means over 25% of its gross receipts, that could also cause a termination of S status. And in certain, and this is an even more, kind of arcane area of terminations, failing to use a permitted taxable year could also cause a termination, although this is, at least in our experience, not something that we come across very often, if at all. So again, a kind of a very specific set of circumstances would lead to termination in that scenario. But again, the most likely cases for termination are inadvertent terminations where, for whatever reason, the S corporation ceases to meet the criteria for S status, and it immediately terminates, or an affirmative revocation, which can also happen from time to time.
Got it. So what are the horrible things that happen, if any, upon termination of the election?
So per se, nothing bad, would happen immediately. Ceasing to be an S corporation is not a taxable event on its own. However, the pass-through treatment of profit and loss items ends. There's a post-termination transition period, which typically runs about a year, but there are some specific rules that can, change the timing of that a little bit, which still allows you to make use of some of those pass-through items. But essentially, it reverts back to being a C corporation upon the termination of that S election. Typically, what would happen if it happens in the middle of the year, meaning, not at the beginning of the year or right at the end of the year, is it'll bifurcate your year into a short S year and a short C corporation year. And then you allocate tax items by default on a daily proration basis. Although the shareholders could also elect to close the books if they so desire. Again, it's not really a problem if you know that it's happening. The issue is, in a lot of cases, you don't, and that's what can lead to issues. Even if whether it's done with the knowledge of the shareholders or not, after a termination, it's worth noting there is a 5-year block on reelecting S status, absent IRS consent, typically through a private letter ruling. So if it happens, it can cause some issues unless you resolve the termination, in particular if it's an inadvertent termination. If you volitionally terminate it, let's say through revocation, that 5-year block will pretty much keep you out of S status for the succeeding 5 taxable years until you're able to reelect, unless you go to the IRS and ask for special permission. But going back to my earlier point, the big issue that comes with S elections terminating is when it's inadvertent and it's not discovered potentially for many years. So this can result in corporate income tax exposure for the company, at least for open tax years. Thankfully, the harshness of this rule is mitigated somewhat. So, generally speaking, as many listeners may know, if you never file a tax return, the statute of limitations never starts to run, which can lead to exposure for many, many years for a taxpayer that hasn't filed its return. There is a rule that specifically says, however, that if you were an S corporation, for whatever reason you stopped being an S corporation, but you still filed S corporation returns, the statute of limitations will run with respect to that corporation for those years as it would if they filed C corporation returns. Meaning that in the case of an inadvertent termination, in many cases, you're not looking at a potentially indefinite look back, but typically the more common 3-year or 6-year statute, depending on the circumstances.
Got it. Got it. In terms of discovering the inadvertent termination, just a quick note. Oftentimes, sometimes, we'll discover that we have a problem right when the S corporation shareholders are trying to sell their S corporation. Buyer comes in and is doing due diligence and says, "Gee, what about X? Isn't that inconsistent with your S corp status?" And that's a real problem because number one, it's going to at least cause delay in closing a transaction. It may, in the worst case scenario, cause the buyer to just go elsewhere and the deal falls through. We've seen situations where closing takes place, but a material chunk of the sales proceeds stay in escrow until we get a private letter ruling from the IRS saying, okay, the termination was inadvertent, and we're going to reinstate your S status retroactive to whenever the date of the foot fault was. So it's a problem, and that's why we need to talk a little bit in a bit here about ways to avoid being in that situation to begin with.
Absolutely. We've spoken about kind of in general terms what can cause a termination of S status, but a question would perhaps fairly emerge. What are the common causes of S terminations that we've seen? I would say one of the top causes, personally, that I've been witness to is getting an ineligible shareholder to be a shareholder in the corporation. So I think of particular concern that we routinely see would be trusts failing to timely make QSST or ESBT elections, and those do need to be made affirmatively. There's a procedure for making those types of elections. Not making that election will oftentimes cause that trust to become an ineligible shareholder. When you have a grantor trust, for instance, and the grantor dies, there's usually a period of time when it remains an eligible shareholder, but after 2 years, it needs to make an election or transfer assets, including the S corporation shares, to another trust that is an eligible shareholder. Another scenario that we come across periodically is a disregarded LLC, which, depending on the owner of that LLC, could be an eligible shareholder. However, if that LLC acquires another owner, then it becomes a partnership. That can cause an immediate termination. A partnership cannot be an eligible S corporation shareholder.
So here's a somewhat common scenario that we bumped into over the years. Dad creates a single member LLC. He's the sole member. The entity is disregarded for tax purposes. Dad leaves a simple will. He says, "Hey, on my death, take my LLC interest and distribute one half to daughter and one half to son." And that creates an immediate partnership. And that creates, in turn, an immediate termination. So it's tricky, and I think the takeaway here is to try to think ahead when sort of agreeing to a certain lineup of shareholders. Another one that comes up is, as you had mentioned, we can't have a non-resident alien shareholder. We can have a resident alien, typically somebody who's in the U.S. for more than 183 days in a given year and is required to file a return. In those cases, we normally would require that person to say, "Hey, look, if you're going to leave the U.S., or either voluntarily or perhaps involuntarily, you got to give us a heads up because you're going to terminate our election uh, the day you become a non-resident alien. So just another example of some of the footfalls that we've seen over the years.
Yeah, absolutely. Another instance would be an S corporation acquiring an interest in another S corporation. Certainly it's not a totally illogical approach, perhaps, for an owner who may not be versed in S corporation rules to assume that that would be fine. And candidly, it is if it's an acquisition of 100% of the lower tier S corporation and you make a qualified subchapter S subsidiary election for that acquired corporation, that's fine. But if you don't, then that causes a termination of the acquired S corporation status, and obviously that Q sub election, qualified subchapter S subsidiary election, can only be made if the upper tier S corporation owns 100% of the lower tier. So if you have an S corporation acquiring something less than 100%, a Q sub election wouldn't be possible, generally speaking, and that could cause a termination as well. Uh, Acquiring excess.
That would cause a termination of the Q or the subsidiaries
Correct. Yeah.
election. So you wouldn't have complete flow through. You'd have flow through only of what's at the parent level on its own, but the subsidiary would become C corp and would pay its own taxes.
Absolutely. And unlike in years past, an S corporation these days can own an interest in a C corporation. So
Sure.
there was a time when that wasn't viable, but since at least the 90s, that has been allowed. So no problem. But obviously, it's a problem for the lower tier entity if it was relying on having passed through treatment. Now it wouldn't.
Gotcha.
Acquiring excess shareholders can also terminate an S election, although I think these days we've seen less of that just by virtue of that family attribution rule. Most S corporations are typically closely held by members of one family, maybe just a couple or a handful of families. And so it's generally unlikely that you run afoul of that 100 shareholder limitation, but it may be possible in certain circumstances, although again less likely these days, I think.
I would agree.
And finally, another common way that an S election can terminate is by having more than one class of stock. This is perhaps a particular caution for an LLC that elects to be treated as a C and then as an S corporation. Because with an LLC, there's a higher likelihood of confusion about being able to issue various types of units. I think the expectation of most people when they see an LLC is to assume that it's a partnership for tax purposes. And with a partnership, you have a lot more flexibility in terms of structuring units. You can do profits interests and various different classes of units, different waterfalls of distributions, and so forth. However, if you do this with an S corporation, that will almost certainly cause a second class of stock issue and a termination of S status if that happens. So just a cautionary note, it can happen with state law corporations as well, especially if you issue various incentive equity. That can cause a second class of stock issue, but the likelihood seems higher, at least from what we've observed with LLCs that have checked the box and elected to be S corporations.
Now, when we're talking about a second class of stock, we can still have voting and non-voting common stock that have the same economic rights to dividends and proceeds on liquidation and termination of the corporate.
Absolutely. Yes. So that's the one carve out that allows you to have effectively two classes of stock is having voting and non-voting shares. What's important is that the economic rights be identical. That's kind of the driving force behind the single class of stock rule.
Terrific. This is just a kind of an example where the client's tax advisors or professional advisors really need to coordinate. If the tax preparer is planning to make an S election and the client calls his or her lawyer and says, I want you to set up an LLC for me, we need to be clear about what's going on with that LLC. If they're going to elect to become a corporation and then make an S election, we need some very special drafting there as opposed to the typical partnership. So
Yeah,
Good point. There we go.
and I would echo that we have seen instances where it was known in advance that the LLC would be an S corporation. Provisions were put in stating that it would be an S corporation, but at the same time, partnership tax provisions were also retained in the agreement, which can, at best cause a muddle and at worst potentially make an invalid S election from the get-go, or cause a termination if it has already elected S status and the operating agreement is adopted. So that's just one more thing to watch out for, in particular with LLCs, just based on the versatility of that entity form. But it's also possible to cause issues with other entity types as well.
Understood. Let's talk a little bit about the kinds of things that we can do proactively to avoid inadvertent terminations to begin with.
Yeah. So the key there would be essentially come down to vigilance, is just keeping track. Obviously, at the get go, to make sure that you have a valid S corporation, and then that it continues to fulfill the requirements down the road. In particular, this would require tracking shareholders and distributions. I mean, distributions, if typically it's pro rata, it shouldn't be an issue. But tracking shareholders would probably be the single biggest area where owners can run afoul of the S corporation rules, is getting ineligible shareholders or what have you. So keeping track of transfers is very important. To that effect, adopting a shareholder agreement can be a very powerful tool to help restrict ineligible transfers. The shareholder agreement can void transfers that would terminate an S election unless there's let's say, sufficient approval by the shareholders of the S corporation to allow the transfer, notwithstanding that it would terminate the S election. You can also require notices of proposed transfers and include other appropriate safeguards. And you have to enforce the terms of that agreement as well. But the shareholder agreement can be, in this respect, a very powerful tool for helping to mitigate, at least on the front end, issues with certain invalid transfers and the like.
I agree. And, as you and I work together on these things, we've got a couple of clients that actually have us look at every situation of a proposed transfer. Usually it's a transfer in trust. Uh, and the shareholder agreement in those instances typically even requires maybe an opinion of counsel, or counsel at least review the situation to make sure that there's no inadvertent termination. Uh, you know, I have another client in particular that I think of that I think does a really good job on this. In their annual shareholder meeting, they will take a bit of time to remind folks of these very issues and to poll them and to actually have them uh, in writing confirm that there haven't been any transfers, there haven't been any changes, for example, in their trusts that are already shareholders. For example, and this our estate planning colleagues deal with every day. There are more options available today to modify the terms of irrevocable trust through decanting a trust or through other procedures, so that you and I might look at a trust document, tomorrow, but we don't know if by the end of the year there have been some changes to that document that either requires a different kind of trust election to have that trust be eligible, or perhaps makes the trust ineligible per se. And so, step one, have a shareholder agreement that sort of spells out these restrictions. But step two, have a mechanism to remind the shareholders of what the agreement says, that it's just not a piece of paper that folks are asked to execute on the day of formation and everybody forgets about and never looks at it again.
Yeah, yeah, that's actually a very good approach. I like that, Bob, of kind of taking the bull by the horns and really affirmatively making sure that the company is taking steps to vet potential transfers. One,
So,
I would also add, though, one I think underappreciated approach is to also have certificated shares. So this can be provided for in the shareholder agreement or in other governing documents of the corporation, but requiring the stock to be backed up by certificates can be a good, at least it's a, a pause or a break on any transfers to maybe, take a step back and think, okay, we're, issuing a new stock certificate. Is this a valid shareholder? It can just, again, prompt a useful pause before, recertificating shares to a new shareholder to make sure that that person or trust is a valid S corporation owner.
That's a great point. Some of our listeners might be surprised to learn that there's an option to have non-certificated shares that are just sort of tracked in on a sheet kept by the corporation without an actual stock certificate. So good advice there as well. Well, notwithstanding all of our diligence, what are our options if we do have a inadvertent termination?
Well, thankfully, there are options if that happens. The first to kind of port of call, if you suspect that you have an S termination, is frankly to examine closely what happened and ascertain, is this the only foot fault that potentially caused a termination? Are there others? So it's a good opportunity to do essentially an audit of the corporation's S election to make sure that that we've identified all the issues, because the kind of the first step of business is to be sure that you understand the scope of the problem, and then you can evaluate what to do. So what do you do once you've established the full scope of your issues? The first is there are some items of IRS administrative guidance you can turn to. There are a couple of revenue procedures that specifically are very useful for addressing these problems. The first is Revenue Procedure 2013-30. The second is Revenue Procedure 2022-19. Both of these offer a way to resolve S corporation issues without having to go to the next step, which is a private letter ruling, which is if you don't have any administrative way of getting relief from a foot fault that caused an S election, you do have the option, if it was inadvertent, to go to the IRS and request that the IRS essentially forgive you for that foot fault and restore your S election. But to do that, you have to file a request for a private letter ruling, and it can be done. We've successfully done it for a number of clients, but it is an expensive process. It's a protracted process, and if there are ways of resolving the issue, namely through those revenue procedures, then that would be a preferential way of addressing the problem.
Those revenue procedures typically give us slightly more than 3 years from the date of the foot fault to fix it. Is that right?
Oh, that's right. So, Revenue Procedure 2013-30 essentially says if you had a termination, let's say, caused by perhaps a failure to make an appropriate election. So maybe a trust failed to make an election to be a QSST or an ESBT. You've got a little over 3 years to make a filing and request relief under the procedure. And in that case, you may be able to restore the S election without having to go to the IRS and request a full bore private letter ruling. Additionally, if an S corporation failed to file an initial election, it can also request relief under that procedure, which is an expedited administrative procedure. And best of all, it does not require a user fee, unlike going to the IRS for a PLR.
There's a difference between having sort of good faith steps available to cure a foot fault on the one hand, and just being sloppy or being indecisive on the other. But for example, with most of the RevProc relief, what we need to do is file a reasonable cause statement as well under penalties of perjury, basically saying, this is what we intended. We intended to become an S corporation, on 1/1/2025, let's say. But for whatever reason, and specifically to lay out the reason, we neglected to file the form on time. We neglected to file the form at all, whatever. It requires a measure of candor and kind of throwing somebody under the bus. Typical example would be, this goes back to our potential for miscommunication. Lawyer and tax accountant are involved. Lawyer thought the accountant was going to do the election. Accountant thought, otherwise, and nobody did. And those are, those are not unprecedented situations. And there are just times when the professional who dropped the ball just has to step up and say, look, I had the ball and I didn't get it over the goal line, which is different than sort of trying to create a scenario creatively, after the fact. Gee, we wish we would have been an S corp, 2 years ago. So can't we avail ourselves of this relief? That's not what's intended. The other is if we've got to do a private letter ruling, one of the requirements is we've got to take expeditious action upon learning of the problem. So the issue there is if there is a problem, the head in the sand approach is not a good strategy. It's best to sort of bring it, to the fore and just deal with it head on and deal with it quickly. Uh, in all the years we've been doing this, Gene, I don't recall that we've ever been denied relief when we truly have an inadvertent termination. Can you?
Not to my recollection, Bob. I think that that's absolutely accurate, and there's a bit of a selection effect because I feel clients who come to us with these issues are the ones who approached everything in good faith, and notwithstanding good faith efforts, there was a termination, so they are good candidates for relief. Perhaps clients who, may be unsure of that, or, certainly we would counsel clients out of it if they just come to us saying, well, we've been a C corporation, but, we wanted to be an S corporation 2 years ago. Can we do that? As you said, generally speaking, that's not going to be an option. It really has to be kind of something inadvertent, some sort of a mistake, kind of a good faith mistake that lends itself to relief.
Terrific. Right before we came on, I just out of curiosity, I went online just to confirm the private letter ruling user fee that the IRS charges if we're out of the 3-year fix period and we have to ask for a private letter ruling is generally $43,700, believe it or not, currently. Unless you've got gross income of less than $10 million, then it drops to still a significant number of, not quite $9,800. Uh, and that's in addition to the professional time to try to put the ruling request together. Because if we're going to do a private letter ruling, we've got to make sure that we include all the relevant facts. Otherwise, perhaps our ruling isn't worth the paper it's written on, even if we get a good response. So it's an expensive process to have a problem that is unfixable pursuant to the revenue procedures. Well, Gene, anything else? Sounds like we've covered the meat of what we wanted to today. Any closing thoughts?
I think that's right, Bob. This was kind of a whirlwind through S corporations and what can go awry with them. But I think what it boils down to is that if you have an S corporation and there's some issue, you suspect there's an issue, or maybe you're trying to sell it, and the buyer confirms that there may be a problem. In many cases, there is a way to solve that issue. Some may be more expensive than others. Obviously, if the revenue procedures offer some sort of a venue to do that, that's great. But even if not, the PLRs would oftentimes provide an avenue to solving the problem. There are options out there. Is kind of what it comes down to, especially if it was a good faith violation. So, it may be perhaps tempting to panic in some cases, thinking, "Oh, there's a problem. This is terrible." But and I don't discount in some cases that it may be a problem that's not resolvable readily. But in many cases that we've seen, there are ways of fixing the problem. It'll take a little bit of time, maybe a little bit of expense, but it can be done.
Well, as our listeners undoubtedly have heard, my puppy Ellie has determined it's time for me to take her outside. We'll sign off for now. We really appreciate your joining us for this podcast. You can reach us at taxstuff at afslaw.com if you've got any suggestions for topics that you'd like to hear. And we're very anxious to hear from you and to entertain those for a future podcast. Thanks again. And thank you, Jane. Great job.